We've been in a bull market for the last 11 years, the longest bull market in US history. This very month marks the anniversary of the continuous upward trend that we've seen in the market since 2009. A lot has happened in the last 11 years, just think about it. It all started at the tail end of the recession, and since then this country has gone through a lot. The economy has expanded greatly, and even personally, my wealth has grown pretty substantially over that time, and I'm sure yours has too. I hope yours has too. We rode the bull long and hard, and it's been a good ride. But is this the end of the bull market? Are things starting to change, and are we now heading into a bear market? What is good? I'm Justin Taylor. It's about 2 a.m. right now. Apparently the only time I can find to record these videos is late at night, but I've been drinking coffee for a while, so I'm pretty fired up right now to talk about the stock market. So as you know, last week we saw a big dip in the stock market. There's been a lot of fluctuation over the past 11 years, which is normal, but last week was the biggest drop in the stock market since the 2008 financial crisis. Last Friday, the S&P 500 fell by 12%, causing the market to lose trillions of dollars in value. Our bull market that we've been a part of over the last 11 years instantly took a massive hit, sending it back to a level it was at almost a year prior. And it did some bouncing around the following couple days leading into this week, but this is a pretty big deal because markets don't drop 10% or more in 1 week all that often. So it's been a popular question over the past few days, is this the start of a bear market? That is the question that I am not going to answer because I don't know. No one really knows for sure. But what I do want to do is simply provide some facts as they relate to where we are in the market and our current situation. And I want to dive into what a bear market actually is so that you know what it is and so that you have a little more information for when or if we do move into a bear market in the near or extended future. So last week marked the start of a stock market correction. Whenever there's a 10% drop in the market from its most recent peak, it signals that we have entered correction territory. 10% is really just an arbitrary number, but anything at or beyond 10% often signals that investors have turned pessimistic about the markets. Somebody said the other day, why is everyone getting so excited about buying into the market right now? All you're doing is buying into an overinflated market and paying a little less than someone did a couple weeks ago for the exact same overvalued assets. And I was like, damn, there's a little bit of truth to that, just a little bit. It's called a correction because historically the drop often corrects and returns prices to the level that they're supposed to be at, realigning the market with where it needs to be for its long-term trend. It's crazy how the market can just balance itself out, and a correction like we saw, although primarily influenced by the coronavirus, is perfect for getting everything back on track where it should be. And these corrections don't happen very often, by the way. We did actually go into a correction last year in December of 2018, but on average, they only happen every few years. But just like last time we entered into a correction, many feared that the stock market would continue to drastically drop this week, sending us spiraling into a bear market, which hasn't been the case yet. I don't know when we'll be in a bear market, but I can tell you for sure that we're not in one right now. You can have a stock market correction without ending a bull market. So we are in fact still in a bull market at the moment. Out of all the corrections that have happened in the last 20 years, only 2 of them have turned into bear markets. The first occurred during the dot-com burst back in 2000, and the second bear market we've had in the last 20 years, the last one we had, was not as long as the bear market in 2000, but was slightly more severe. And that was during the financial crisis back in 2008, as you probably expected. During that time, the S&P 500 dropped by nearly 57% from its peak, and the bear market itself lasted 517 days. But what defines a bear market, and how do we know when we're in one? While a stock market correction occurs when we see a 10% drop in the market, a bear market occurs when we see a drop of 20% or more. And in comparison to a correction, a bear market is, as you might imagine, more severe and usually a more sustained downturn in the market. Ultimately, a bear market is caused by a loss of investor, business, and consumer confidence. That's ultimately the reason why we, over time, move into bear markets, a lack of confidence. And that lack of confidence is usually triggered more or less by rising interest rates. High interest rates make it harder for businesses to operate and grow because it costs them more money to scale, and this eats away at their profits, which does 2 things. forces them to increase prices of their products or services or whatever they sell, which results in their customers buying less, leading to less revenue. And it also causes investors to scale back because they don't want to put money into a company that isn't growing and that won't hit its expected earnings. And when investors start smelling something fishy, that's when they cash out, when they don't see strong earnings potential or things are looking uncertain. That's when the majority of investors start dumping assets. Interest rates have been on the climb over the past couple years, but funny enough, this week the Fed did an emergency rate cut, cutting the interest rate by 0.5%, which, believe it or not, is kind of a big deal. From what I read, I think the rate cut actually backfired. It was supposed to build confidence in the economy, and I think what it ended up doing was just creating more panic. Also, other big news that happened this week, I think this was kind of overlooked with all the coronavirus stuff that's going on, but the yield curve did another inversion this week, usually a warning sign of a recession. I feel like I'm getting a little too deep in the weeds here though. If I start talking about yield curves and interest rates, I'm gonna end up falling asleep. There's a lot of methods for trying to predict when a bear market will begin, but none of them can pinpoint the exact moment it'll happen. Plus, everything with the coronavirus right now is really adding another level of complexity. Now, if we do happen to eventually move into a bear market, here's what you can expect. Bear markets usually have 4 different phases. The first phase is characterized by high prices and high skepticism from investors. This is when people start losing trust and begin dropping out of the markets and selling their investments. In the second phase, stock prices begin to fall sharply and trading activity and corporate profits begin to drop. This is where investors begin panic selling and getting rid of their investments, even at a loss. They don't care if they're in the negative, they just want to get rid of it. And this, of course, drives stock prices down and starts the whole domino effect. The third phase is where things start to turn around. And depending on how long the bear market is, this could be months or even years after the start of the bear market. But speculators start to enter the market, which starts raising prices and generates some activity in the market. This is where things slowly start to pick up. And finally, in the fourth phase, this is where things start to really turn around. People feel confident, there's optimism about market growth, prices are relatively low, so it's an incentive to buy in, and the bear market starts to turn into a bull market again. Keep in mind, we've seen some skepticism with the market lately, as well as a little bit of panic selling, but we're not in a bear market yet, so we haven't actually entered into any of these phases. But all in all, this is kind of the flow of a bear market. What I haven't mentioned so far yet, though, is recessions, which I think is also worth mentioning when talking about downturns in the economy. Corrections of bear markets focus specifically on the performance of the stock market, but recessions are tied to a country's gross domestic product. When gross GDP sees a decline for 2 consecutive quarters, that's when a country is considered to be in a recession. A recession and a bear market usually go hand in hand, so oftentimes when we have a bear market, we'll also be in a recession. However, since they're both determined by different factors, that's not always the case. There have been periods in the past where we've had recessions without being in a bear market, and we've had bear markets without being in a recession. None of these are necessarily bad, by the way, in my opinion. These are all part of a natural cycle. Corrections, bear markets, recessions, there's opportunities to make smart financial moves in each of these situations, which I kind of touched on in my last video. It's all about leveraging your current situation to your benefit. There's always opportunities available, even in the worst of times. All right, hopefully I taught you something about bear markets. Once again, it's unknown when our long-running bull market will come to an end, but it will happen at some point in the future. I covered a lot of ground here, so if there's anything I missed, let me know in the comments. Like I've been saying, I feel like this is a scary but exciting time right now. It'll be interesting to see what the future holds. All right, I gotta go to bed. Until next time, peace.